It's the Black Real Estate Dialogue. Tune in. Tune in. Tune in. Tune in.
No one could have, I personally don't think anyone could have predicted the interest rates would be what they were now. Like, you know, to have a program that will need the money to fund like this, like I just don't see how a company would say, oh, well, we know rates are going to be at historic highs than they've been in the last 14 years. So let's do this program now. And to your point, it's not like a snap of a finger type of situation. And something else I want to mention too is like there's this outcry about this program, but there's no outcry about NACA, which has, in my opinion, it's a lot more difficult to get through. And it's been funded by Bank of America for the last 25, 26 years. No one is saying that though.
Exactly.
Yeah.
And then I would say the other thing that I hear too about this program is, like I said, it's somehow set up for this whole concept that somehow like Bank of America wants to give out loans to people that they think will default on the loan, just so that they can come and purchase the homes from them later on. So like that also like doesn't really make a lot of sense, because if Bank of America just wanted to buy a home in minority communities, they would just buy the homes. Like they don't need to give out loans to people, hope they'll default, carry the cost of the property, then get the home. And if someone's not like paying the mortgage, they're probably not taking care of the home. They potentially have to like go through like rehabbing the home, or going through selling the home at a lower cost than it was before. Like it just doesn't make any sense from that aspect. And then two, like the biggest way like banks make money off of loans is like servicing the loan and like mortgage-backed securities, right? So for folks that may or may not have a mortgage, but I know like I have three mortgages. So in the last 10 years, I probably called my bank like 3 or 4 times in the last 10 years, but they're making money off of servicing the loan. So it's like passive income as far as the bank's concerned. And then the other aspect is like the mortgage-backed securities, where they package up a bunch of mortgages and sell them off to investors. So if they have these loans that folks are defaulting on, like it doesn't work with actually selling the loans to the investors. Like they become pretty much like they lose their value. Like there's no investor wants to buy loans that folks are going to default on like 2 or 3 years from now. So like the whole concept that they would make up this program for folks to like default on loans that they can't sell to investors, it doesn't make any sense from that aspect either. And so like I said, I've worked at Wells Fargo. Like I worked at Chase, and I've given out, like I've worked in minority communities, and I've given out loans to people. And so like there's because there's no decree where it's like there's some meeting where it's like, hey, make sure you're targeting these people or that. Like it just still wouldn't make any sense, because I'm just an average person. The average people that work at these banks, like somebody would come out and be like, hey, Bank of America came down and said that, hey, make sure you're targeting folks for this loan because this is the plan, or something like that. It just doesn't really make any sense on a big scale or small scale, as far as a lot of these conspiracy theories that I hear.
Yeah. And as somebody who has worked in the mortgage business for quite some time, when you hear people saying, when you hear people saying they're doing this so people can foreclose, like to me, at a high level, it doesn't seem like that would even benefit the bank. Wouldn't they benefit more if you continue to pay your mortgage for the life of the loan than if you foreclosed? And what are your thoughts on that?
Yeah. Like I said, it's the ultimate passive income. It's just they give loans to solid borrowers, and they never talk to them ever again. Like that, their ideal goal of any mortgage company, anyone servicing a loan, is to give out a loan. That's why you go through such a rigorous underwriting process, and to never talk to that person ever again unless they want to refinance. Like that's every mortgage company's optimal situation. It's just to collect money passively off the interest. So like, yeah, it doesn't make any sense they would be going through a process where it was like where there was like a lot of like back and forth, or the potential to actually have to unfortunately foreclose on the loan. And also there's actually a lot of steps before foreclosure. Like lenders will do what's called like a loan modification when you're like a financial hardship, where you can't refinance the loan, but you also can't pay for the current loan due to your current financial situation. Like lenders will also try to like modify the loan, which is basically, and there's a couple ways to modify the loan. one is sometimes they'll forgive like a large past due balance you have. Sometimes they'll just lower the rate on the loan. And then sometimes they'll just like extend the term of the loan. So let's say you have like a 30-year loan and like year 20, you fell on hard times. Like they may extend your loan out to 40 years. So now your $2,000 payment becomes like $1,100 or something like that. So there's a bunch of steps between giving someone a loan and foreclosure. And so like it probably takes like up to a year to foreclose on a home. So like once again, Bank of America would be losing money that whole year that someone is not paying on the loan, whether it's, the property taxes, whether it's the legal fees to foreclose on the home. Like it just doesn't really make a lot of sense. I think once you kind of really, really like dive into like what actually has to happen for a mortgage company to actually foreclose on somebody's home.
Right, right. And something else is people keep saying, oh, this is why the 2008 crash happened. This is 2008 all over again. But what's important for people to understand is like, it was a different time back then. Anybody who breathed, anybody who could write their name on a paper, anybody with a pulse was able to get a mortgage, right?
Yeah.
There was the Wild Wild West back then. Like people were getting qualified, people were getting approved for mortgages who literally couldn't qualify and nobody cared. However, what's important for people to understand is there's been a lot more regulation put in place. It's a lot more of a rigorous process to get approved for a mortgage since then. And it's going to be the same thing with this program. Like how would it benefit the bank to approve somebody who can't actually afford the mortgage? Like if the mortgage is $3,000 and your income is $3,500, and if you think you're going to get approved for this program, you're out of your mind. Like it's not going to happen.
Yeah.
So how do you respond to that?
Yeah. And so when we look back at 2008, there are basically two big things as far as 2008. As you mentioned on it, like the reckless lending habits. It was like, hey, if you say you make $10,000 a month, you make $10,000 a month. There's no income verification or anything like that. And then the other part, there was just like so much inventory. Builders were building, and there was just this massive amount of inventory back in 2008 compared to now. And so like we're on the exact opposite now. So like mortgage guidelines are just a lot stricter than they were in 2008. I think if folks remember, like when COVID hit, like Chase was actually one of the banks that actually like very, very, very tightened their lending habits. They require lenders to have like a 700 credit score and 20% down. So like banks have actually gone the exact opposite way, and they've gone back to their normal lending habits now. But yeah, it takes a lot more to qualify for a loan now than it did basically back in 2008. It's like one of the things I hear is folks would be like, "Hey, well, they're doing like no credit check." So it's not like no credit check. It's not like, "Hey, we're not looking at your credit at all." That's not a thing. Like similar to, as you mentioned in the beginning, like Bank of America, they underwrite like the NACA loan, so they have experience working with alternative credit. And so a couple things as far as the loan, it basically goes by like the conventional loan guidelines for the most part outside of credit. So you still need a 50% or less debt to income ratio. Your debt to income ratio is your monthly finance debts, like your minimum payments, like on car payments, student loans, stuff like that, plus your future mortgage payment divided by your income before taxes. That needs to be 50 under 50%, just like a conventional loan. And then the other part, as far as like credit, so they'll use like the non-traditional credit as far as like utilities, car payments, and stuff like that. However, like it's not just like, hey, you paid your car payment, you're good to go. You need to have like 3 trade lines, as far as you basically mean to have like three trade lines or 3 credit scores. And then also you cannot have any late within like the last 6 months on your credit report. That's why they need to see your credit report. And so if you have a late in the last 6 months, sorry about that, you can't get the loan. And in the last 12 months, you can only have like 1 30-day late on your entire credit report. And so basically you can have a late between like month 6 and month 12, just 1 30-day late, which is a lot. I mean, you can apply for normal loans, conventional FHA, and have lates like within the last, I mean, it'll impact your credit score, but you can have lates, applying for a conventional loan or FHA loan. So they're basically looking at like your habits, not necessarily your credit score, but they're actually like looking at your habits. So another big difference with this loan is that it's manually underwritten, meaning that the underwriter is actually looking at every aspect of the loan. Like there's 2 types of underwriting. There's manual underwriting where an underwriter is like looking at every document and they're making the decision. Then there's automated underwriting where your information is plugged into like a basically a computer system, and then the underwriter is verifying that the correct stuff was put into the system. But in this situation, they're actually going through all your documents and basically giving you a thumbs up or thumb down as far as loan. So it's still a strenuous like qualification process. It's not just like a paper stamp like they were doing back in the, like I said, the wild, wild west of the 08s, 07s, that time frame.
What's up, y'all? Sam here from the Black Real Estate Dialogue podcast. Thank you so much for watching another episode. Definitely take a moment to subscribe. Make sure you like this video. Also, visit our website, blackrealestatedialogue.com, and follow on Instagram @Black Real Estate Dialogue. Talk to you soon.